Okay guys, last time we did accounting assumptions, right? Accounting assumptions mainly talk about how we report financial information in financial reports, and this one, qualitative characteristics, is focusing on the qualities of the information that should possess when we report them, and also qualitative characteristics usually explain how the information should be like, right? So how the information should be presented in the reports, and how they are going to support the financial information. So basically, meaning we have to provide the financial information in such a way that it will support the decision making. Okay. So basically, these are what are these things? Qualities of the financial information, and as a result, these qualities explain how they should be presented to the user so that they can make use this information for their decision making. So as you know guys, as we have done in 1-2 as well, we have 6 characteristics. Of course, the dominant main one being relevance, right? And then faithful representation and so on. Usually guys, remember all the other things, right, except relevance, all the other all the other qualitative characteristics are supporting relevance. So probably by now you already know, right? Now for when we talk about maybe faithful representation or comparability, verifiability and relevance basically clashing a little bit. I'll explain you. Comparability, timeliness, understandability, all of them actually support the relevance. Sometimes there is one part, one area, faithful representation also kind of clashing little bit with relevance. We have already done that part in depreciation. Okay, right? So depreciation we have done. So I will remind it when we do depreciation part in unit 4. We are coming across depreciation again in unit 4. Okay guys, now having explained the characteristics, the other one is, now first one is relevance. Now this definition is the full definition that is available in your textbook, right? However, right, this is basically the ultimate standard that you have to write. Then you can ask me like whether we need to memorize, right, by heart, memorize the information, the definition, kind of, not all of them, kind of you need to remember. So basically what is it? Relevance states that the financial information that is reported should support the decision making of the users. That's a simple thing. That part definitely you have to remember. Definitely. Okay. That there is no excuse. You guys have to remember that. However, the full format is not that. Full format is relevance states that information should be capable of making a difference to the decisions made by the users in such a way that the reports provide relevant information, reports report relevant information, and then those things basically help the users to form predictions or confirm their previous evaluations. What does that mean? So what does the second part means? Relevant information must be related to an economic decision, then to form predictions or confirm their previous evaluations, right? Okay. So, and also it says, guys, relevant, this one is not very clear. Relevant information, right? So relevance informs which information should be included in the reports. So, and which information should not be included in the reports. Okay. So basically, guys, first I will explain you the second part. First part, of course, we have done, that should be fine, right? So whatever the information should be helping the users to make their decisions, yes, right? Then relevant information must be related to an economic decision, right? So let's say we have a business and we are asking an investor, right? We are asking a partner to join with us, right? Maybe your siblings, maybe your parents, whoever, or friend, right? We are asking them to join our business, right? Then, now let's say that man is going to make the decision whether whether he's going to join with the business, whether he's going to invest his money in the businesses, that the information provided should be supporting his decision, right? Maybe he has already he has already made a decision, right? Whether he's going to join to the business or not. Now our information, basically, like our information should be quality enough to, let's say, kind of for him to get an idea whether he is going to join, right? Or like if he has already made a decision before, then it is going to confirm the previous one. So then sometimes, yes, if the information is, right, if the information is not quality enough, he might have changed his decision that he has taken before, right? So basically, the relevant information, so what the summary is, relevant information should be capable of making or should be actually supporting the economic decisions of the users, right? Right. So then they can form predictions, they can assume some things, or they can confirm their previous evaluations, things like that. Okay. So let's say he didn't know anything about our business, then by looking at the information, he will get an idea. This is something like this, right? This is a good one, or this is a bad one. On the other hand, if he had thought about what the business is like, what the business look like, then he will confirm that previous evaluation, right? So basically, that's the story. Okay, guys. Then, as we said, relevance information informs which information should be included in the reports, and then, as a result, remember, relevance is supporting accounting entity assumption. Remember, when we were doing accounting entity assumption, we said it is supporting the relevance. Now, when we are in relevance, we are saying link to the entity assumption, right? Why is that, guys? Because we can't include, now see, this one is saying relevance informs which information should be included. Then accounting entity is saying only the information that is relevant to the business should be included. If there's anything for the owner, we have to exclude it, right? Then the balance sheet, right, will include only the asset that is relevant to the business, okay? Right. Now, The point is that, of course, we are including only the useful information that is relevant to the business decision making, right? So then, personal assets, liabilities we have excluded from the business reports. Then the other one is, guys, relevancy is supported by what is it? Period and accrual basis assumption, right? Period and accrual basis assumption. Right. So remember we said that when we report the information, right, we have to include information that is only related to a particular period, right? So then accrual basis also said, remember, we have to match the revenues earned for a given period along with the expenses incurred. Okay, right. Then income statement basically has to report all the revenues earned and expenses incurred for the period, so that we calculate the profit for the period, right? Okay. Then there's another part, guys, materiality, right? Materiality. What is materiality? What do you mean by material? Yes, material. We will say material. Yes, it's material enough. So basically, significance, right? So let's say, for example, guys, we purchase. Yeah, let's say we purchase a stapler or a calculator, right? Basically, in value it is less, yes, maybe less than definitely $50 or $20, something like that. And then, what do you think? Is it an asset? We purchase a calculator. Is it an asset? Can we use for longer time? Yes, we can definitely. We can, if we purchase a calculator, right? You can use it for long time. My calculator, scientific calculator, I have it with me for 14 years, and also still the same battery. I haven't even changed the battery. Okay, so then, so you can use it for a long time. Okay, then the point is, right? Let's say we have other assets like worth of, tens of thousands of dollars, right? Maybe we have vehicles, maybe shop fittings, right? Things like that, furniture, right? So more than maybe 10,000, right? I mean, the value would be more than 10,000. Then the point is, are we going to include that $50 calculator in the assets worth of tens of thousands of dollars? Not really. Why? Because the point is, so including that $50 calculator is not going to change any decision of the users, because the investor or somebody is not going to change his decision based on that $50. Why? Because the other values are high. Maybe like sometimes if it is a big business, its values can be in millions. So that means we are going to include that $50 in the millions. Doesn't make sense, yes? Right? So that means it is not material enough. It's not material enough, okay, for the decision making. So then what do we say? The size or the significance of financial information should be determined by the value of the transaction in such a way that omission or mistake in that would make a difference to the users. Who are using financial information, right? So then, investor is going to invest money. So $50 we have included in that one, or in the non-current assets, or we haven't included it. Doesn't really matter. Why? Because it is just $50 with big value items, right? Okay. Right. Any questions with this? However, we can do something. Let's say we have, right, similar items, right? So let's say calculators, things like that. We can say office equipment or something. We have similar items, but they basically make up a big value. Or then you can add them together and record it as an asset. Otherwise, let's say if we don't have something like that, then what would we do? We will identify it as an expense, right? $50 you spend for a calculator. Yeah, it's true that you are going to use it for more than 12 months, but still we will identify it as an asset. As an expense. Because no point in depreciating it and depreciating it by $5 every year. No, doesn't make sense. Right? Okay. Right. Any questions? Yeah, that's guys basically what is it? The first one, relevance. Okay? The relevance. Right? Then the other one we are going to discuss about the faithful representation. Right? Relevance is the biggest or the longest characteristic. However, the other one, which is the faithful representation, is the second longest. Right? Faithful representation, what does it say? Faithful representation say the financial information should be, financial information reported in the reports should provide faithful representation of the real world economic events. Right? Real world economic events that are complete, free from material errors and neutral. Right? So basically, the financial information that is reported in the reports should be reflecting the real world economic events where such information are complete, free from material errors and neutral. Okay. Now in this definition, guys, there are 4 parts. Okay. What are the 4 parts? 4 parts would be, first one, complete. Complete means what? Sorry, the first part means not complete, sorry. First part is real world economic event. What do you mean by real world economic event, guys?
Like current economic events?
Yeah.
Like happening right now?
Yes. Whatever that happens in the reality. Okay? Whatever that happens in the reality should be reported in the reports. That's the real world economic event. Make sense? So let's say, for example, we purchase a printer, right? We purchase a printer, let's say this is, I don't know how much it is, let's say 5,000, right? We purchase a printer for 5,000, right? That's the reality. Then you have to record it as 5,000. You have to record it as printer 5,000. You can't record it as 4,000, or you can't record it as 10,000. No, that's not the reality. Reality is that you paid 5,000 and then you have to record it as 5,000. That's it. That's the reality. Then, after 1 year, right, what will happen to this one? Value will increase or decrease?
Decrease.
Value will decrease, yes. Value decreases. Then, that's the reality. Then you have to record it. That's the real world economic event. Real world economic event is if the value usually decrease decreases for the man-made items, then value will decrease, then we have to record it in the reports. That's the reality. Okay. So then, that's what I said. So basically, financial information that we are reporting should be reflecting the real world economic events that happens in the business, where those information should be complete, free from material errors and neutral. Okay. That's the real world economic. What's the second part, guys? Complete. Complete means whatever the information we report should have a minimum description and a dollar value. That's it. That's the completion. So if you purchase a printer, you say, okay, printer $5,000. That's it. That's the completion. Simple as. Next one. Free from material errors. Free from material errors means, guys, what does that mean? Can we have immaterial errors? Yes. Immaterial errors you can have, right? $5,000 you can record it as 4,999. That's fine. Okay, $1 difference, that's okay. Not material. But you are recording it as 500 or 50,000, and then that's a material error. Okay. Then that is accurate. So basically, free from material errors means the information should be accurate and they should be verified to support its accuracy. Right? And then, as I said, the immaterial errors wouldn't affect decision making. Because recording 5,000 as 4,999 wouldn't affect the decision making. Finally, guys, so basically remember the free from material error explains about the accuracy of the information, right? And also the extent to which that they can be verified by the source document. So if you are saying this is 5,000, where is the invoice or where is the receipt, bank payment confirmation or something. The final thing is, guys, neutral, without bias. So information should not be subjective, right? What does that mean? So we are asking the owner how much is a printer, then he's saying, I think it is 5,000. Now, what he thinks is not an import, because why? Another man will come and say, accountant will say, no, this is, I think it is 4,000. No. So what is like subjective to a person, right? Personal opinions are not important. Why? Because they can have mistakes. So then they are not neutral. They are with bias. Why? Because we are giving our opinion based on our perception, or based on our information, based on our knowledge, right? And maybe our conceptuality, experience. So then they can change from person to person. So that is not important. So what people think is not important. So as a result, we can't have usually, guys, estimates, right? Because why? Estimates don't have source document, right? So then what do we have to do? We have to be objective, meaning if you are saying this value is 5,000 now, we should be able to produce the source document. Okay. Any questions with food or allowance? Right. Next one, guys, verifiability. Right? Verifiability. Verifiability is actually pretty straightforward. You can have a look, pretty simple with 4 lines, right? I think it's the shortest one. Okay, verifiability says financial information should allow different knowledgeable and independent observers to agree that an event is faithfully represented. What does that mean? Right? Basically, it is done by the support of the source documents. So, financial information, right? Let's say now we are going to provide our balance sheet, income statement to our parents. Let's say we have a business, or we are going to do a business. I mean, let's say we should have a business, otherwise how can we provide our reports? Yes, we should have a business, or otherwise we can have budgeted report, whatever. Okay, then we are going to present it to our parents to get their consent, or to bring them as investors, whatever, or maybe a friend who hasn't done accounting. And my parents also haven't done accounting. Sometimes your parents also haven't done accounting. Then we are going to present it. This is our plan. This is our reports. Then they have different knowledge, right? Also, there is another person, a friend of us, or somebody, or our siblings. They are knowledgeable. They know accounting. They have done accounting. Then, so by looking at the information, same information, they should be able to come to the same conclusion. That's it. So then the parents are looking at the report, they don't have, accounting knowledge, right? Then they are saying, this business is doing really well. Then another person who is knowledgeable about the accounting, also reading it, wonderful, right? Then, what is it? Now see, they have different knowledge. So see, different and also independent. They are not biased, like as investors, even though they are related, they are not biased because they are investing their own money. So then, different knowledgeable and independent users will agree that this information has been reported in a faithful manner. Right? Whatever that has happened, right, has happened in the has been reported in the reports correctly, right? Okay. Then, guys, basically it is done by the retention of source documents, right? And also, right, verifiability is thus the core approach of ensuring the faithful representation is upheld. Right? Even actually, this is what have you heard about there is a party called auditors?
Oh yeah, auditors.
Who are the auditors?
They're like in the tax, sometimes you get called for a tax audit if like
Tax audit.
Audit where it's like maybe something's wrong or not correct and you've got to prove.
You mean like from the tax ATO?
Yeah.
Okay. Have you heard about the audit, Sandhu? Yeah, auditors means people who check the reports, right? Tax audit, yes, that's also there are auditors, you are correct, right? Apart from that, guys, now we have companies, yes? Companies, okay, so he's doing business management, he knows well, right? Companies, there are two types of companies, yes? What are those, Sandhu?
Public and private?
Private and public. Have you heard about them?
Yeah.
Right? Private and public. So private companies means what? They are the businesses owned privately. Right? So your parents can have companies. They are basically private. Public companies means, private companies means like they want to keep the ownership of the business within a limited group, maybe relatives, family, friends, something like that. The other one is, guys, public company. Public companies means like big businesses, large businesses, right? Like Coles, Woolies, Harvey Norman, right? Those are big companies. feature is that they can issue their shares in the share market. So anybody can purchase it. So public companies, guys, must be audited. Their reports must be audited. Right? So why is that? Because owners are different. Owners, even like there is a set of managers who is running the business, but owners, share owners, maybe even haven't seen the managers, at all. Same thing. Managers also haven't seen the owners. So that means two different parties are, like business is owned by one party, another party is running the business and making profits for the owners. Then owners are interested about looking at the reports, whether the reports are prepared well. Yes, that's where owners will require auditors. An auditor is a third party, independent party, that will come and refer the reports and say, they will tell the owners, look, this is all good. Otherwise, they'll say this is horrible. They have done some frauds. They have done some funny things that shouldn't be done. That shouldn't have been done, right? So then, how the auditors is checking that one is on this. Also, see, that's also meeting that one. See, then auditors will come and say, look, they are independent, right? And then they'll say that what has happened in the reality has been reported. No problem. Otherwise, they'll say, okay, the business has made a lot of money, but most of the money has been taken by the managers, directors fraudulently. Right? That's the, what is it? Comparability, guys. Sorry, verifiability. Right. Any questions? Next one, comparability. Okay, guys, comparability. What's comparability? Comparability means the financial information reported in between different periods. That means what is it? What was reported last year and what is reported this year, right? And also the information from two different businesses. Right? Let's say you have a business, he has a business, then the information should be able to be compared. Right? Your same information in between different periods, last year and this year. And also information from two different businesses, maybe competitors, should be able to be compared. Then what is it? That means we should have done we should have run the same practices, right? Now, for example, now both of you guys are into sports. You play cricket, you play basketball, right? So, let's say, do you have every time, let's say you are playing a match, right? This week and next week you are playing another match. Would you have the same set of rules or different rules? The same rules, yes. In the team, in the side, you will have 11 people, right? So next time you won't have 15 people in the side, right? Same rules. When you have the same rules, that's same thing for basketball, like 5 years, 5. So then, but there are situations that changes, right? But however, usually 5. So then, the number of players who are playing in the match in the side should be the same, yes. Basically the same rules. When we have the same rules, what can we do? We can compare the results. Last time this is our score, this time this is the score, we can compare. Right? If we can't do that, if we have changed the rules, we can't do that. Right? We can't do that, can we? No. So then guys, what do we say? Usually we are saying, so in order to compare the information, we should be having the same set of rules so that we will not have different performance because if the rules are not consistent and if any difference occurs, then we don't know whether the performance difference occurred due to the change of the rule or actually performance has changed. Yes? Make sense? Then guys, does that mean that we can't change the rules? We can. We can. The thing is, see, if any accounting procedure is different, what do? I have to disclose it. What do you mean by disclose?
Like state.
State, reveal it. Reveal it clearly. So you have to say that. Look, this one we have changed from over this period. Right? So that's the story. We are going to talk about it, especially about depreciation. Depreciation, we have in your study design, we have two methods, right? But there are more. If you are doing general maths, right? We are learning more depreciation methods. Even in the uni also you have more depreciation methods. So basically, if you change the depreciation method, then you have to mention it. However, yeah, we can change it. Comparability is not, so because there is a misunderstanding within the students, and also sometimes teachers also don't know, sometimes they also don't know, they don't say that, but see, you can change it, right? If you change it, what you have to do? You have to disclose. Then the other thing is, there is something like this. You can't change it over and over. Okay? You can't change it over and over. Okay. This, last period we had the method, right? One method, right? That's the method A. This year we are using method B. Okay, that's fine, acceptable. Then again, next year you are going to method A. No. A, B, A. No. You can't do that. You can't change over and over. Right? So we can't play with the rules, right? Okay. And also guys, comparability is linked to period assumption. Right? Why? Because remember we said that period, if you set up a period, length of the period, if it is monthly, you have to go like that. Right? Then do you want to, like, let's say somebody wants to change it to quarterly. Can you change it? Yes. Right? So last year you were doing monthly, this year you can change it to quarterly. Again you can't go back to monthly. So you can't keep on changing. Okay. Right. Then the next one, guys, timeliness. Right? Timeliness is also pretty short. Timeliness is saying, what is it? The financial information should be available to decision makers in time. What is the difference between in time and on time?
In time is before.
Before. Yeah. Yes, before the deadline. Yes. On time is just at the time. You know the difference on that day. Financial information should be available to decision makers in time, so that it is capable of influencing their decisions. Right? Okay. And also this one talks about the more updated information. Right? We have to include more updated information to the decision making, so that it will lead to better decisions and results. Right? So we can't give, like, let's say we are asking our parents to join our business, we are giving like 5 years financial reports 5 years ago. No, it doesn't make sense, right? Yeah, so we have to give more updated information. Fine. Understandability, guys. Right? Understandability means we have to we have to provide the information in an understandable manner for the users, because everybody that use financial information hasn't done accounting, right? And it doesn't have to be, right? There are a lot of people who hasn't done accounting, but they are doing really well in businesses, right? So then, financial information should be understandable, right? For everybody, basically people who have a fair knowledge on economic activity. But however, they need to have a knowledge about economic activities. Otherwise, they can't. Otherwise, they can't read it. Then we can't make reports for everybody. Yes, people who don't have understanding about economic activities don't have. Can't read anyway reports. Okay, so then this understandability again supported, and also this one, guys, understandability is saying that we can classify. Classify means what? We are classifying assets into current and non-current. That's the classification as current, non-current. Categorizing, we are putting assets separately, liabilities separately, and financial information, and we use simple language, and then we don't use the jargon. Another meaning of jargon, highfalutin jargon. Jargon means what? Technical knowledge, terminology, right? Technical terms. We have to avoid it. We can't do it for 100%, but we should be able to avoid it. Right? Okay, so for example, simple language using graphs, charts, tables, etc. That's it for the assumptions. Sorry, characteristics, guys. Any questions? Okay, then I'll give you questions. Alright, shall we do it? First one.
Is it relevance?
Relevance. What do you think, Sandeep? Relevance, yes. Why is it relevance?
Because it's the business money she's
taking.
For her own use.
So, but isn't she the owner, and can't she spend the money as she wish?
She can't.
She can't use the money as she wish.
She can, but she has to
Yeah, she can.
Ah, she can. Okay. That's good.
Yeah.
That's good. I like different answers. That means you guys are thinking, right? That means if everybody is saying the same answer, that means you don't say it. Let's say you say that, then the other one also copies that. That means the same man. No, I like the difference, Yeah, that means you guys are thinking, right? So see, this is, guys, accounting is not a magic, right? Definitely, it's not a magic. It is something that we have day-to-day life. Only thing is we haven't thought about it. Yeah? If you, this is basically helping us to think about our own economy. Our economy, not the country's economy, our economy. Right? We are basically, what is it? Firstly, trusting, what are the economic activities, Lakshan? Tell me.
Economic activities.
Yes.
Like what? Like inflation rate?
No, inflation is not an economic activity. You forgot?
I forgot everything economics.
That's good.
After the exam, I can.
You can, oh my god, that's done.
No more.
Yeah. So economic activities, firstly, guys, what is it? Consumption.
Oh yeah.
We have to what? Eat, yes? That's a basic thing. Without eating, we can't survive, right? Once we have eating, then we need place, we need then clothes, right? Then we need the house, right? So like that. Then after that, the rest, car, or then from there you can go ahead. When you have a car, you need boat. When you have a boat, you might need a jet or go onwards. Yeah. All right. Then, guys, right? The economic activity, consumption. Then what else? For us to consumption, like we need money. To make money, we need to have a job. Right? Then, and also, if we need to make money, we need to consume, somebody has to make the product. If we need to eat rice or bread, then somebody has to make it. Yes, basically the same thing, right? So that's in the economy, but this one personally also similar thing. We need to eat, we need to have a job, right? So basically in accounting, we go in depth and we focus only in the financial perspective. But economics, what is it? Economics, we have financial and non-financial both, yes. But mainly in accounting, we are going into financial part. Okay. Right. Then, guys, yes. So basically, you guys are correct. So actually, guys, we can't stop. Nobody can stop. Even the God can't stop. Right? The owner is using his business money on his personal things. Even I would do that. Right? Anybody can do it. Right? I mean, somebody who has so both of you are parents are doing businesses, so they can't stop it. Yes, they have their stem. But the thing is, accounting comes and says, look, you can do it, fine, but you have to record it. So it's relevance, right? Okay, take it down. Also, guys, sorry, I couldn't ask you. Is the spacing enough for writing?
Yeah.
No? Okay, guys. Question number 2, part B. What do you think about this one? Verifiability? You said straight away. Verifiability. Okay, we'll see.
Let's say verifiability or maybe faithful.
Verifiability or faithful, yes. Actually, mainly what would you say out of the two? Verifiability or faithful? Verifiability is correct, yeah. Why is it correct? So now, she purchased the premises for 500,000 10 years ago, I mean 2010. But now it is more than 1 million, 1.1 million. So then which value are we going to record?
Which value do we record?
Yes, now we have 4 values, yes?
Yeah.
500,000.
I have to record the original.
Original value. Is that correct? Yes, why is that?
Is it because the faithful?
Yeah, basically yes, because why? Other things, do we have source documents? No, not verifiable. Verifiable means what? There should be okay, if you are saying, okay, now the highest value is 1.2. If the owner is saying, oh no, I'll go with the 1.2, then next time, auditor or somebody is coming and asking, where's the source document for this? No source document. Then, no. So that means, guys, 500,000. Does that mean that we can't record 1.2? No, we can. We can, as long as we have a valid source document, like when we are going to sell it or something, we can put it. But there are some other ways that we are valuing it. Basically, we call revaluation, right? Opposite of the depreciation, right? Depreciation, what is happening? The value is going down. But this one, actually, we call appreciation. Actually, guys, now, like if you have read some business articles and news and things like that, like right now, McDonald's mainly, we think that they are selling fast food. But now they are into real estate business. They have when they are selling the business, basically they are selling it with the premises, right? So there is but the franchisee, that means, let's say we also can become franchisee. That means we can buy a outlet and then we can form a McDonald's. But basically we can't make the profit like they are making the profit, like they have set up the business like that, right? But we are paying for the premises, but they will own the business, they will own the premises. Over a time period, what will happen? Oh my God, the value of the premises will increase. Yeah? So then they are in that game. So rather than like selling the fast food, okay. So sometimes, like the business, I have read some case studies. Business hasn't really, like over 10 years, let's say you had a business and you are going to sell it, right? Business hasn't performed much well, but the property has performed really well. And then you are making a big profit. Yeah, now my first property we purchased 10 years ago. I checked last week the value. Imagine what has happened. The price is double. Yeah, so in the future, you also, guys, if you want to make money, invest in property. Yeah, invest in property. property also there are a lot of actually things that you need to learn, but before you...
But so isn't this, around this weekend, like it's gone up, the interest rate won't change, it was going to go down.
Go down, yes, but because of the inflation, my God.
I actually, before the exam, I asked my teacher, do we have to include the 3.2, the change in inflation?
Yeah, she said no, yes.
She said yes.
Really?
Yeah.
Ah.
Then we had to include it. She also called, because her husband used to be, he's retired now.
Examiner.
He used to, examiner, but before examiner, he used to be head economist at Westpac and ANZ Bank. He used to work there, and then he was examiner after that. He said have to include the...
Yeah, but however, yeah, the thing is, yeah, you can remember what I also...
She said, like you said,
what I said, yeah?
You just got to state as of September.
As of, yes,
it's 3.2
yeah,
now.
correct.
Yeah.
Yeah. So, the thing, but did you have to mention it? I don't think.
I didn't have to.
Yeah.
But in the question, like it asked, like where inflation rate was included, you could talk. You can talk about any.
Yes.
You can talk about during the quarter.
Yeah.
But you can
talk. Yeah. As I told, remember what I told? Like I told you, kind of like a smart thing, right? So if you get a chance, like to support your answer in that way, you know, like then you mention it, right? Then like basically you can capitalize the situation to your own benefit. That's what I would do. But always when we refer to the data, Lakshman, you have to like basically give the timing. As of this time, this is the thing. Oh. I don't think they really expected, you know, the recent one, because it came like one day before, yes?
Yeah.
And by the time, you know, as I told you, questions are done, they would have done like in that reducing trend of the inflation. Because everybody thought that, you know, there will be another rate cut because the inflation will reduce, but now it has increased. Okay, guys. Then, yeah, this is verifiability takedown. No? Okay, guys. Alright, next one. It's pretty straightforward, this.
Oh, comparability.
Comparability. Timeliness, you sure? No, not timeliness, Sandhu. Why? They are talking about, what is it? In 23, business reported every month. 24, it started reporting every 6 months, and then thinking about 12 months next year. Yeah, what do you think? Relevance? No. Which one it said that, so this is basically about the length of the time, yes? If it was an assumption, then what would you say? Period. Good. Then characteristic. So which one is linked to the comparability? Okay, yeah, correct. Next one, guys.
I'll say verifiability or faithful.
Verifiability of faithful. Give me the paper, the tube. Made a change.
Yeah, I'd say verifiability.
Yep.
Or even, faithful. But I said mainly verifiability.
Mainly verifiability, yep. Yeah. Verifiability or faithful, last one. Verify. You, Sundar?
Yeah, verifiability.
Verifiability is correct. Also, you can say faithful as well. Why? Because we said that the owner cannot, nobody can put estimates, right? So, according to faithful as well, but either of them is fine. Okay, what about the other one, guys? Party. This is a tricky one. This is not very straightforward, but kind of straightforward as well. But
Is it relevance?
relevance? No.
Understandability.
Understandability? Very good.
Yeah.
You change what to what?
Yeah, I understand.
Okay, why do you say understandability?
Because when it's listed in current assets and non-current, and non-current liability, current, it's more precise and more easier to understand.
Yes, correct. Very good, Sandip. Yeah, understandability. Yep, good. Yes, Sandesh, see, you have a good conceptual understanding, yes, even though you don't like accounting. He doesn't like accounting anymore, Lakshman, but still he does well, yes?
Done, sir.
Okay, guys, next one. Right, what is this one? This is a little bit tricky.
Where I build.
Verifiability issue. But he has a bill. He found the bill, yeah?
Oh, you found.
He found it, yep.
Oh, timing.
Timeliness? Okay, we'll see. Timeliness?
Yeah.
Yeah. Yes, very good. Both of you are correct, guys. Timeliness is correct. Right. You can see without glasses?
Sort of.
Forgot the glasses?
Yeah.
You've been using from childhood?
No. When I was like 14.
No screen time?
No. My pupils got big apparently. Like retina or something.
Sorry?
Like change like the retina, like
Retina?
retina.
Retina? I don't know.
It's like in the eye. It's like
Okay.
sharp, see?
Okay.
Yeah. I'm thinking of getting laser.
Really?
Yeah.
Okay.
If my dad lets me.
Okay. Laser, you have to be careful.
Yeah, but like glasses is really annoying.
Yeah, I know. Because laser, sometimes you can get double vision.
What do you mean double?
That means you will see me like two.
Oh.
And there's a risk like that. Like one of my friends has it.
Really?
But they'll try to fix it. But he said, so basically he was using glasses. Actually, even I had the same thing. I also should be technically wearing glasses, but I don't wear. I used to wear it for like 12 years or maybe 10 years, like that. I started first using when I was 8 years old. I have a squint. What do you call it? They call it here something. Sorry?
Short side?
Short side, and also the pupils are not parallel.
Oh.
So yeah, so then my like about 25 years ago, the second best eye surgeon in Sri Lanka, he said that don't get it operated. So that by that time they were cutting, like by hand. At that time the laser wasn't there, because he said that if they cut it more accidentally, then you'll get a two vision. So then I thought about it. Then similar thing is done by the laser, but laser is more updated, more high tech, because they are doing it very accurately. But I thought that same problem can happen with the laser. Now, because with my friend, he was a carpenter. He was living here, so he said that he got it. Then he was using glasses. Then he lasered it, and then he got the double vision. Then after that, sometime they tried to fix it. He said that like to a large extent they fix it, but still there's little bit. Yeah, so then you have to be careful. But I think most people get it lasered these days, yes? Yeah.
Because nowadays it's more modern.
Modern, yeah. That depends person to person. Some people, no problem. They will be wonderful, but some people can get double vision. Even I think yesterday you wanted to do, I remember. I told the same story to her, so I don't know what she did. She's using glasses as well, yeah?
Yeah, thanks.
Okay guys, what about the next one?
Understandability.
Understandability? Yeah, so why? Because
So
jargon, and also not to impress the others, yes? Like, rather than impressing, we have to give the message to the people. So we have to present it in a simple language. Next one is tricky.
So the B understandability.
Understandability. Understandability, sure. No, understandability. No. Relevance. Interesting. Verifiability? No. It's nothing to do with the source documents.
So it's got to be relevant.
Relevance? Okay. Why did you say relevance, Sandhu?
Because you wouldn't be able to understand if like they're two all together, and it would be hard for decision making.
Will help for decision making, like in which way?
If they will separate.
Separate it? Okay. What do you think, Lakshmi? Why do you say relevance?
Because my answer was wrong. I'm not sure.
Yeah.
I don't understand it.
Understand? Yes. Actually, this is a bit tricky. Now, this one actually I got from the one of the sets in Atmosphere. So it's really interesting. This one is actually yes, relevance. Yeah, Sandhu is giving a lot of correct answers to it. Yeah, good. So yeah, basically, guys, why is it not understandability? Now relevance is, I'll quickly tell you, the why it is relevance is because this is just talking about liabilities only. Remember there was another question before that? Yes?
Liabilities and assets.
That one was both assets liabilities. That one understandability, no problem. This one specifically about liabilities. Why do we need to, let's say assets, forget about it, like anything. Not classified, we don't really care. Liabilities we are classified. And why? Then the owner knows that he has to raise money to meet his short-term debts, right? Then because we have short-term debts, then he has to meet them firstly. Then he can, basically he can figure out how he's going to meet the short-term debts, right? Then he can later worry about the long-term, but short-term debts, he has to get some decision, like when he's going to pay, how he's going to pay for his decision making. Yes, current liabilities is important. So basically, guys,